Good morning and welcome to this Thursday, February 13th. Oh, it's hard to believe February 13th, but February 13th, Trading Places Live. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. And I tell you what, we got futures a little red today. That's okay. Warned a little bit about that yesterday to Earnings Beats members. I'll talk about that in just a couple minutes. But I think it's just a brief blip. I don't see anything big coming from it, but we do see the futures down this morning. We got a lot of things to talk about today, so let me go ahead and go through the agenda with you. We got the daily market recap, of course, so I'll go through, tell you a little bit about what happened yesterday. Then talking technically, I'll show you the chart that I'm referring to, where there was a bit of a warning that we might see a little turbulence ahead in the near term. So again, I'm not too surprised by the lower futures this morning. Also, we're going to talk about healthcare. Healthcare looks pretty strong to me, not just the XLV, which is the ETF, which is on the verge of a breakout, but all of its component areas I think look very bullish. So XLV looks pretty good. And of course, in a secular bull market, while we're advancing, most areas of the market should look good. And these areas do. But a couple of them just breaking out, I think you'll want to definitely take a look at that. Then I'll get into earnings spotlight. Had a couple big reports out overnight. Cisco and Applied Materials both reported and both heading in opposite directions this morning. Upgrades and downgrades, got a few of those to share with you. And then, of course, wrap up the show with the three you must see. So let's go ahead and start it off and take a quick look at the daily market recap from yesterday. And really, when you look at the market, you see breakouts again. Dow Jones Industrial Average yesterday breaking above 29,500 for the first time in history. So we are now within 500 points of that magical 30,000 level. Never seen that one, obviously, before. So, you know, one or two good days, that's all it would take for the Dow to get there. Of course, with futures this morning, doesn't look like it'll be today, but we never know. The S&P 500 also closing at yet another record high, 3379, up 22 points. The NASDAQ, another record, up 87 points, back above 9,700 at its highest close, 9,725. Mid caps also broke here to a high not seen since back in mid-January. So we're not breaking out yet, but we are heading in the right direction. Small cap still on a relative basis lagging a bit. First, got to try to negotiate that 1025 level, and then maybe we can make a march up toward that mid-January high. Energy stocks leading yesterday, up 1.34%. I think we, had that huge sell-off with the big drop in crude oil prices. Crude oil seems to be stabilizing. I think that's given traders a lot more confidence to get back into some of these energy names. 20-day moving average, those being tested. That'll be an interesting test to see whether or not we can get back up above that. Obviously, getting through that would be very bullish in the near term. Communication services made a breakout yesterday, a new closing high. Technology also closing at a new high. This is all part of a very, very strong secular bull market advance that we've been seeing. Discretionary also breaking out. Amazon's been on a roll, and Amazon is 23% of the XLY. So if you want to know what's been going on here, all you need to do really is take one look at that Amazon chart. But not all consumer stocks doing well. Yesterday, staples actually were down. The overall uptrend's clearly in play, but we did see a little bit of profit taking in that group. The 10-year Treasury Yield, I'm going to pull that up here. One of the things I was looking at on the 10-year Treasury Yield, and I'm going to shorten this chart for you. I want to just take a look at maybe the last 3 months. I did an interesting calculation here. And the calculation, what I looked at, and I always talk about when the 10-year Treasury Yield goes up, it means that money is rotating away from treasuries. The selling of treasuries is what causes the yield to rise. The yield and the price are inversely correlated, 100% inverse correlation. So if treasuries are selling off, the prices are dropping, the yield goes up. Prices are going up, yield goes down, always. If you take a look at the yield, I went back and looked at these 3 days where you see the yield going up, these 2 days, yield going up, this day, these 2 days, and then these 2 days. And what I did is, if I also show you the chart of the S&P 500 over these same days, Now I'm going to go back and show, so we can show the 3 days. So here's the 3 days, 6th, 7th, and 8th of January. So if you go forward and look at what the S&P 500 does on the 6th, the 7th, and the 8th, we went up. If you go back and you look at these 2 days, which is the 17th and 18th of January. So again, 17th and 18th of January right here, the S&P 500 went up very nicely from where it had closed back on the, or I said 17th, 18th, that was 16th and 17th. So from the close on the 15th, you can see the movement up and so forth. But anyway, rather than bore you with each one of those moves, what I did is I calculated where the S&P 500 was on December 31st and where it is now. So 3230 versus 3379. And of that 149-point gain, I looked to see the days when the yield was going up, how the S&P did, versus days when the yield went down. And the days when the yield went up, the S&P 500 went up 220 points. And when the yield went down, the S&P went down 71 points. So that net 149-point move on the S&P from right here to up here, 220 points of that move to the upside, obviously more than that, more than the 149 points. 220 points we moved higher when the yield was rising. When the yield was going down, we lost 71 points. That's what gets us to that 33.79. Anyway, I just thought it was interesting. As I looked at the chart, I just saw like here was one of the big moves in the S&P, and it came with the 10-year Treasury yield doing well. So as I go back and I look at the 10-year Treasury yield, and maybe even stretch this out, let's look at a one-year chart. Let's take a one-year look at that TNX. When you look at this, the stock market has been rolling since October. And look at what has happened to the yield. The yield's done nothing. So I keep saying that if the economy really picks up and if the Fed ever gets the dollar to weaken, I think they do need to cut rates. Some might think I'm crazy, but hey, we've got moderate growth with no inflation. That's a perfect environment to cut rates, especially when you want to inflate the economy. So if the Fed ever begins to cut, and I think that's what the bond market's been pricing in, I think once you begin to see any kind of an uptick in inflation, I think you're going to see the 10-year Treasury yield start to rise. And when that 10-year Treasury yield starts to rise, we're going to have a lot of money rotating out of the bond market and into the stock market. So I've been on record. I said this year we were going to hit 4,000 on the S&P 500. A lot of people thought I was crazy and probably still do, and that's fine. And maybe we won't get there. But my rationale for getting there is that I believe the Fed, which had completely botched everything a year ago, finally went from hawkish to dovish. They finally got it right. But I think they're still a little bit slow on their trigger. I think they're going to cut again. And when they cut, I think might be the final cut. We'll see whether or not what happens, after the cut. But I would suspect that they're going to cut to try to weaken the dollar, which in turn lifts commodity prices and hence inflation. And we start to inflate the economy a bit. When that happens, I believe the 10-year Treasury yield starts to rise. And that is going to lead to a very significant rise, even from where we are now in the S&P 500. My belief. We'll see. All right. I talked about the fact that, short term, very, very short term, I wouldn't be surprised if the market fell. Well, one of the things, and I pointed this out to members, I'll show you the chart that I sent out to the members, basically the same chart, but annotated. You can see the higher prices here on the S&P 500. This is an hourly chart that goes back the last month. But you can see as prices keep going up, you see how the PPO is lower? And we saw this slightly back in middle part of January. We had a lot more warning signs back in the middle of January, by the way. Equity-only put-call ratio was off the charts. The VIX was giving us a warning. Seasonality, the positive seasonality was ending on January 17th. From October 28th to January 18th is actually the best period of the year. So there was just a lot of stuff coming together, and we did actually take this drop at the end of January. I'm not looking for anything like that, but you can see back there we did have negative divergences as well. Higher prices with the lower PPO. So the annotated chart that I sent out to members, you can see that right here. So just pointed out exactly what I just said. So the last time we saw the higher prices, the lower PPO, what I look for is a center line test on the PPO and a 50-period test. which we got here. Now, we ended up going lower, but this doesn't tell me that we're going to have all of this weakness. It just tells me that things are getting a little ahead of itself. Wouldn't be surprised if we get a little bit of a pullback to test that moving average in the center line. Same development here. So again, the market doesn't go up forever every day. It runs into some momentum issues, and I think that we hit that and we started to pull back. Well, we didn't really start to pull back today. I think maybe we're starting to pull back a little bit. There's no guarantee that we go back down to these levels, but it's just a little bit of a short-term warning that tells us we can. So after writing this yesterday and sending it out to the members, and that went out yesterday about 12, a little past noon, I wasn't at all surprised when I woke up this morning and I see futures down. It just happens. That's the way the market works. If we go back and we look at this one right here, you can see that that day we actually had a little bit of reversal that day, but the next day we actually gapped down to get down to that 50 period moving average. Now we're not going to gap that far. It doesn't look like it at this point this morning, but maybe later today or maybe over the next couple of days, we could either go down and hit this 50-hour moving average, or maybe we go sideways, go down and kind of go sideways while the 50 comes up and meets it. There's a price support area around 33.47 or so on the S&P from the last breakout that we saw right here. So those are some things to think about. A couple other things in talking technically, I mentioned the healthcare. So let's take a look at healthcare. Here is the XLV. Now we had a beautiful uptrend followed by some solid sideways consolidation. You might call this a little bit of a cup. So if we do pull back today, maybe that's a handle back to the 20-day. Breakout above, say, 105 would measure up another $6 in the near term. That would be 111. 111 versus 104. That wouldn't be a bad move on healthcare, but we do need to, if we do see that handle develop back to the 20-day and then we get the breakout, that's what I would be looking for. And the beauty of it is when we look at the various industry groups within healthcare, you will see all of them are bullish. Every chart I looked at, healthcare providers. Here we got an uptrend. See the negative divergence, higher prices, lower PPO. We ended up going a little bit below the center line, but that momentum issue on the daily chart needed to be resolved, and it was. Now that it's been resolved, now you see prices moving up, volume picks up, and look at the PPO back in positive territory, starting to point higher. I think healthcare providers look really good here. The pharmas, go ahead and pull those up. Same issue. On that last high back in the middle of January. And again, there were so many warning signs back then in January with negative divergences in a lot of different areas of the market. But you can see the pharmas right here, higher prices, lower PPO, right back down. We didn't get to the zero line on the PPO. We didn't quite get to the 50-day, but we got close. And we haven't broken back out yet on this group, so maybe we continue to consolidate. We could, with futures lower today, maybe this is the day we do get that 50-day test on the pharmas. But I think this consolidation at some point will come to an end. And when it does, I look for pharmas to resume this prior uptrend. Next up, Biotechs. I've spent a lot of time here over the past week, couple weeks, really last few months. I've been talking about the Biotechs. I really like the Biotechs. Second half of January, once again, what did we have? We had higher prices, lower PPO, rinse and repeat. We saw this over so many areas of the market. Negative divergences, everybody betting on the market to go higher in terms of the put-call ratio, that equity-only put-call ratio. It had gotten down near lows that we hadn't seen but maybe 3 times in the last 15 years. So the sentiment was off the charts. There were a lot of reasons why areas of the market needed to pull back. Those issues, in my opinion, have been resolved. And now you've got Biotechs coming back up, breaking out, and also just moving back up above the zero line. Momentum is strengthening. Could we pull back? Yes. I would be watching not necessarily the 2200 level. Maybe we get one more pullback. I'd be shocked if it went below the 20-day moving average, though. So I think Biotechs have made their breakout. Last couple of days, I think, beginning to confirm it. But there's nothing that says we can't pull back a couple of percent, 2 or 3%, to potentially get that 20-day. I like the Biotechs here. Medical equipment stocks. So when you look at the medical equipment group, look at this. Beautiful move up. Really no negative divergence here. And in fact, what I'm seeing, I'm going to shorten the chart. Let's actually go with 6 months. And then I'll annotate this. So we've got an uptrend. And when any stock, industry group, whatever, major index, anytime you've got a uptrend and then you seem to put in a top and you consolidate, I start looking for patterns. I look for bullish continuation patterns. Why? Because we've broken out, we're all-time high, and I think that we have much more to go to the upside. Now that line going up is a little bit steeper. I wouldn't be surprised maybe if we come back down close to the 50-day, something like that, where we maybe it just comes down and tests the low we saw earlier this week. But right in there, that wouldn't surprise me. Uptrend followed by a symmetrical triangle that squeezes. Eventually, we get a breakout to the upside. That's what I'd look for. But this is a bullish pattern. If it does develop like this into this symmetrical triangle, this is a bullish pattern. And then the last group that I wanted to talk about was the medical supply group. And this group just broke out right above that 1,000 level. So after the pullback, went right back up, cleared it. I think the group looks awesome. So, you know, when I look at not just the XLV was in that cup. So let me pull that back up again. So we've got that nice cup, and we've seen some of the areas of healthcare breaking out, others on the verge or near breaking out with very bullish patterns in play. So I think that this pattern will play out. I do think that we're going to see perhaps a little bit of weakness, maybe to put in a handle. But when we break above 105, I look for a measurement, first measurement, initial measurement to about that 111 area. All right, let's go into the earnings spotlight. I'm going to start with Cisco. And Cisco, not a very good response to their earnings. And before I even talk about their numbers, let me annotate this and just show you a couple of things here. Number one, we went up yesterday. It looked like maybe we were breaking out because we got above these highs and above this high. But really, we just filled that gap. From, you see this big volume gap down back in August? That was an earnings report. So we've been doing, and then here was another earnings report. So we've got a history here with Cisco of gapping lower with earnings reports. And when you look at the relative strength, you know, right here, this is a problem. First, you've got Cisco downtrending relative to the telecom equipment group. But telecom equipment has been moving lower versus the S&P 500. So you've got a stock here that was getting ready to report earnings. It's got a history of disappointing. It's also been an underperformer in an underperforming group. So going into this report, I'm not sure why anybody would have been overly excited and expecting much in the way of bullishness. That's certainly not what the charts were suggesting. And we didn't really get any bullishness. They did beat on their top line barely. They beat on their bottom line barely, 77 cents versus 76 cents. Revenues were 12 billion versus 11.98 billion. So they did have slight beats, but I think their guidance disappointed. It was just in line. So they didn't raise. And in this environment where you see a lot of these other larger companies, not just beating, but raising, I think that inline guidance spooked traders and they gave up on Cisco. Stock is down 5% in pre-market. So it looks like it's going to open somewhere probably just below the 20-day moving average. I think it needs to go up and clear yesterday's high before I'd be even thinking about Cisco. So as long as it's sitting back here in this range or it's trading down or it's, you know, showing terrible relative strength, no reason to jump into Cisco. Let's wait and let's see Cisco actually begin to report better numbers and actually start to trade better. We'll actually see it on the charts before we see it in the earnings report. And right now I'm not seeing it on the chart. Now, let's flip the story here, flip the script. Applied Materials, beat on the top line, beat on the bottom line, guided higher, part of a very strong group. So here's your semiconductors. Just looked at the telecom equipment group, how it was downtrending versus the S&P 500. Semiconductors are uptrending versus the S&P 500. So this is a group that's getting more than its fair share of the money in the rotation that always is taking place in the market. And so being in a stock like Applied Materials, which for the most part had been moving higher versus its peers, it did dip just recently, but it was during a period of consolidation. And we've talked about this many times. You're going to see a stock, just because the index goes up higher doesn't mean an individual stock's going to go up every day. It's going to outperform for a while, and then when it goes into its period of consolidation and the group keeps going higher, you're going to see a little bit of weakness. Would I have been overly concerned about that? Not really, because the overall uptrend's in play. Volume trends, I think, still remain very bullish here on Applied Materials. And the stock is set to open up a couple percent higher. So maybe we're looking at $67, maybe something like that on the open, or maybe just a little bit below that. After that, I mean, maybe we get a pullback, because I do think that there is some good things that have been built into the price of Applied Materials as we've been moving up. You can see back in November, we had a nice report and a gap up. You can see the selling that took place afterwards. And then we had another rally heading into earnings. So I think we'll get this gap up. I'm not sure what will happen after the gap up, but I do like Applied Materials. I think this is a strong company, and any kind of a pullback, 20-day test, that sort of thing, would be a buy for me on Applied Materials. Many of the semiconductors in that space looking really good. Lam Research, especially strong, I think. And then you've got, Intel, which has been very strong. So those are some of the names that I like in that area of the market. Some other earnings reports. Tell you another bad one. And again, this is just another cockroach in the kitchen. Network Appliance. We've seen these gaps, these big gaps down. We're going to get another one today. Stock is trading down 12.25% pre-market. They missed on their revenues. They missed on their bottom line, $1.16 versus $1.19, and then they guided lower. So it truly was the trifecta of bad news for Network Appliance. Look at the computer hardware group. It has been a great area of the market. And of course, we know Apple has been a strong performer, but there's also Synaptics and some others that have performed very well in this space. Look at what NTAP has been doing relative to its peers. And even with the computer hardware group outperforming by a mile versus the S&P 500, Network Appliance is in that strong group, and it actually had been downtrending. I mean, at best, maybe sideways consolidation, versus the S&P kind of going along with the ride. Although the last 3 months, we can see it's been dropping again. It's just not been a good performer. And when the market drops like it did in January, Network Appliance drops even more. When the market rebounds, Network Appliance doesn't seem to rebound as much. But going to get a big drop today, 12.25% at the open, which would be, about $7 or so, something like that. So we're probably looking at $53, $54. I would watch this opening price right here at $53.40. If this is one strategy I use sometimes with trades. Now, if I was thinking long, I would want Network Appliance to open above $53.40, trade down below, and if it came back up above the open today, that's when I would think about getting back in. So in other words, let a false breakdown set up and then have it come back up. That would be an indication maybe to get in. Now, if it gaps below $53.40, all bets off. I'm not interested in it. I probably wouldn't do anything with it. And I won't trade it anyway. That's not really my style, to trade companies that miss on their earnings and revenues and guide lower. But I'm just saying that might be a short-term type of a trade if we get a false breakdown. All right, number of other companies out, but I'm going to keep moving on. I will say TripAdvisor's TRIP up about 4% pre-market. Pretty nice report there. SunPower, SPWR getting crushed. They actually beat. They guided revenues higher, but stock's down almost 10% pre-market. I think you got to be a little careful there. CenturyLink, CTL down 4.25% with its earnings. It just matched expectations. And IFF, we'll pull this last one up for you. IFF, it's down 4% pre-market. They beat on their bottom line, but they guided their fiscal year 20 earnings per share lower. And another one, it was making a move here on a relative basis, or trying to, right here, last couple of months. Couldn't get the breakout. I think you're going to see that start to roll back over. It's not in a great area of the market, and that's part of the problem here with international flavors and fragrances. All right, quick look into the upgrades and downgrades. Let's start with Caterpillar. Caterpillar upgraded today. I look at the chart. I see sideways consolidation. It did get back up above the 20-day yesterday, but it still got a little bit of gap resistance to deal with. just above 140. It did hit or got close to a 52-week relative high to its peer group, but the peer group has not been doing well. This was kind of a mixed signal here to me. I don't know. I'm not sure I agree with the upgrade. But anyway, Caterpillar did get upgraded today and is up about 0.5% in pre-market. Cummins CMI upgraded as well, also just getting back through its 20-day moving average. Stock's been downtrending, though, since that triple top back in December. On a relative basis, not looking very good. In the same space as Caterpillar, which hasn't been a great area of the market. I don't know. I don't really see it here. I'm not liking that upgrade. Downgrade, couple downgrades are stocks that have been doing really well. Enphase, look at this move and breakout. Clearly a leader in the renewable energy space. Got downgraded today. It's down 3% in pre-market. Tell you what, a 20-day test there would look pretty strong for entry to me. And also a downgrade, Shopify. Shopify, another company, came out with earnings yesterday. Big gap up, black candle off this uptrend. I think we're going to fill this gap, maybe even go down to the 20-day moving average. I'd be a buyer at the 20-day. Shopify had a great report out yesterday. All right, let's wrap this thing up with the three you must see. And I'm going to start with LJPC, La Jolla Pharmaceutical. I don't know how you pronounce it. But I don't like that candle yesterday. And anytime, this is, we've got a really nice move here from $4 to $9. I don't know the news. I didn't go back to look at the news, but obviously something happened. The stock went up more than 100% in 4 days, but came back down, tested the 20-day, and yesterday looked like it was breaking out again intraday and then failed and came back down, actually printed a bearish engulfing candle after a false breakout to the upside. I would expect short-term weakness here. Now, after this huge move, the stock deserves consolidation. If I had been in it, say if I had been fortunate enough to buy on the 20-day test, when it got back up to resistance, I probably would have sold. But if it maybe soared right through resistance intraday, I would have likely held until I saw that reversal. Anytime that, and that's probably the biggest question I always get, when do you sell? Well, as a short-term trader, when I get a false breakout at resistance, that's usually a good time to take profits. You always get back into the stock. If it goes back a little bit lower, you can get in cheaper. Or if it breaks back out again, you can always, just buy back in a little bit higher price once you've negotiated that resistance area. Second up, MDT. This is Medtronics. They were lowered today, I think, by Goldman Sachs to a sell. And I actually agree with this one. And I like the company. I mean, it's nice uptrend and everything. The problem I have is a negative divergence on the weekly chart. Now, when you get a negative divergence on a weekly chart, lower PPO, higher price action, and you look down to where the 50-period moving average is, which right now it's at 102 and the stock's sitting at 116, yeah, that makes me a little bit nervous. So I think MDT is one that I would be a little bit careful about. Now, if we look at it on a relative basis, here's the double top. We're probably going to lose this maybe today. I don't know if we get with a sell rating, I'm sure we're going to get a gap down. Probably going to lose that support level. Going to lose maybe the 50-day moving average. That's going to create a lot of selling, I think, in the stock. Just keep in mind that long-term uptrend in play. And also keep in mind, this is a pretty good performer versus the medical equipment group. I just think it got a little bit ahead of itself. So we got to watch this one, maybe see it as it pulls back closer to that 50-week moving average. The last one I have for you today is United Health, UNH. This is part of the healthcare. I talked about healthcare earlier. I'm very bullish. I'm really bullish the healthcare providers, which broke out, and you can see UNH, United Health, making that breakout as well here on the weekly chart. PPO starting to turn up again. I think UNH looks really good here. So anyway, I think that is about it for today. Another wrap. I'll be back on Monday over at Earnings Beats with Trading Places Live. And of course, be right back here on StockCharts TV Tuesday at 9 a.m. Everybody have a great rest of your week. See you then. Happy trading.